The U.S. Labor Department reported the first slight slowdown in annual inflation growth in months on Wednesday, with gasoline prices easing off record highs, suggesting that inflation may have peaked. But it wasn't all roses as food prices in April continued to climb higher and rents increased by the most since 2006, meaning the country's struggle with inflation is not over yet. Stephen Rasciuto, chief economist at Mizuho Securities, breaks it down.
First of all, the components that we consider flexible have started to lose upside momentum. But the components that we consider sticky, such as homeowners equivalent rent and medical care, are remaining inflated. But the year-over-year growth numbers have started to decelerate because of base effects. So I think when you put it all together, you're seeing inflation going in the right direction for the right reasons, but it's not coming down as quickly as markets, or for that matter, I think the Federal Reserve will be comfortable with.
The Fed last week raised its policy interest rate by half a percentage point, the biggest hike in 22 years, to combat soaring inflation. President Joe Biden on Tuesday acknowledged the pain that high inflation was inflicting on American families and said bringing prices down was his, quote, top domestic priority. The Consumer Price Index increased 8.3% in the 12 months through April, higher than what economists polled by Reuters had forecast, indicating the Fed still has its work cut out for it. Still, April's number represented a slight decline from March's peak, which was the largest year-on-year gain since December 1981.
I think it is the beginning of a moderating trend in prices as we go forward in here.
U.S. stocks initially rose after the CPI report, but lost ground in the afternoon as Wednesday's inflation data cemented expectations of aggressive interest rate hikes.